This is what normally happens when you buy a home with a 30-year mortgage. Let's assume that you bought the home for $850,000 with a 20% deposit, which is 170 grand. Therefore, you need to borrow $680,000 from the bank, which is the mortgage. And assuming that the interest rate over that 30-year period is 6%, therefore, over that time frame, you would have paid the bank an interest of $787,000 over that 30-year term. Now, let's assume that your capital growth out of this property is 3% every year, so 850,000 times 1.03 over 30 years is $2,063,000. But that's not the true account because you got to subtract the loan interest, so that 2,063,000 minus the 787, so you got the potential growth or gain of $1.276 million. But you have to factor in the rates, the insurances, and also the maintenance costs over that 30-year time frame, but also the opportunity cost. What could you use that $170,000 elsewhere? Could you have invested it? And also, just as another thing to consider, should you buy a home or a rental? Because a home isn't a guaranteed investment, because a lot of the time some people will say that, hey, a home is an investment, but when you think about it, the capital growth isn't guaranteed. So some cities don't even have a growth. Where I live, the average was about 6%, but that isn't even guaranteed as well. So if you look back at the last 2 years, it hasn't really grown that much. And so that's why I've used something around that 3%, whereas a rental property, you've got the income and the potential of the capital growth. So the income is obviously the rental income where the tenants are paying you rent. And if you're new to my page, I'm a financial engineer. I'm all about mortgages and personal finance tips. If you want to learn more, be sure to follow and like.